I just got off the phone with my client, Mark. He said, "James, I just got a bonus, but I don't know what to do with it. Normally I'd invest without thinking twice. But Trump is being Trump, the world feels chaotic, and the stock market? It's through the roof. Everywhere I look online, people are calling this an AI bubble. My gut says don't touch it. But what if I wait too long? I'm only 5 years from retirement. What should I do?" Sound familiar? If you've ever stared at your brokerage account and felt your stomach drop, you're not alone. Markets are at record highs, headlines are screaming about AI, inflation, and bubbles. But the real question is this: should you panic, sell, or actually stay the course? Today, we're diving into what's really happening with the stock market, why valuations look sky high, the stories that trap investors online, and, most importantly, what you can actually do with your money. Let's start with the numbers. One of the most reliable ways to gauge stock market risk is the Shiller-Cape ratio. Basically, it tells us how expensive the S&P 500 is compared to historical earnings. Right now, it's sitting at levels last seen before the dot-com crash. That crash wiped out a decade of gains. Investors who bought at the peak had to wait 12 years just to get back to where they started. That's a scary thought if you're 5 years from retirement like Mark. And it's not just the Cape ratio. Look at AI. Everyone's talking about it. Tech giants are spending hundreds of billions on data centers, infrastructure, and deals that sometimes feel like money moving in circles. There's excitement, but the question is there real gold here, or just glitter? Here's where it gets interesting. Yes, valuations are high, but let's zoom out. Since the 1980s, the market has been drifting higher. Why? 3 big trends. More investors, more money. Financial literacy is up, apps make investing easy, and millions of new people are participating in the market every day. Central bank insurance. Since 2008, the Fed has intervened like never before, bailing out banks, injecting liquidity. That knowledge makes markets feel safer, which can justify higher prices. Corporate balance sheets are cleaner. Companies have moved from generous, risky pensions to defined contribution plans. That means fewer liabilities and more stability. So maybe high valuations aren't a bubble, they could just reflect a new normal. This is crucial. Narratives drive behavior more than numbers. Social media, financial blogs, and even YouTube videos push extreme opinions. You see headlines screaming, "Sell everything. This is 2000 all over again." But here's the truth. People don't wake up thinking this way. They've absorbed a story that someone else told them, maybe for clicks, maybe for influence. The danger is thinking these narratives are facts. The key is perspective. There's always another story, and often, it's just as convincing. Mark's big fear. Buying now and the market crashing tomorrow. But here's the reality. Research shows timing the market rarely works. A 2017 study looked at 100-plus years of data. A simple buy-and-hold strategy returned 6.6% per year. A timing strategy, switching between cash and stocks based on valuation signals, returned 7.4% per year. Slightly higher, yes, but more volatile. And after fees, virtually identical. The problem is that valuations can drift for decades. Trying to get out at the right time is like predicting the weather in 2050. It's almost impossible. So, what should Mark and you focus on? Control what you can. Diversification. Invest across countries, sectors, and asset types. Don't bet everything on one country or one tech stock. Long-term focus. Mark's bonus isn't going to retirement in a year. It's 10, 20, 30 years. Markets grow over time, and betting against human ingenuity rarely pays. Gradual investing. For nervous investors, phasing in money over a few months can ease anxiety. Markets may rise, they may fall, but the key is staying invested. The truth. Even seasoned investors struggle with timing. I've seen it myself, sitting in cash, waiting for a better entry point, while markets climb higher and higher. CAPE ratio equals high, but not a short-term alarm. It's more predictive over 10+ years. Markets can stay expensive for years. Don't assume a crash is imminent. Diversification and long-term thinking beat headlines and fear-driven moves. Narratives are powerful. Audit your information sources. When Mark asked me what to do, here's what I told him: focus on the things you can control. Keep your investments diversified. Don't chase the headlines. Remember, this money is working for your future, not your next news scroll. If you take one thing away from today, it's this: investing is a marathon, not a sprint. The world will always throw stories, fear, and hype at you, but your job is to focus on the long game. And if you want to see what I found when I looked at markets after all-time highs, spoiler, it surprised me, you're going to want to watch the next video. Trust me, you'll want to see this.